One of the commercial real estate experts in a 46,000 member Dallas-Fort Worth real estate Facebook group has recently started telling the thousands of real estate investors the bad news. Their houses are plummeting in value. Real estate has historically been perceived as an adequate investment due to its relative scarcity and everyone's need for housing. Yet just because humans need housing doesn't mean investors should hoard housing. Humans need oxygen, but nobody stores wealth in oxygen. Just like other consumer goods and other financialized assets, the potential for creating more real estate is inevitable. With advancements in construction technology and the availability of undeveloped land, the supply of real estate can expand, debasing its value. It's worth noting that roughly 50% of Earth's land remains relatively untouched by humans. There is still a significant amount of undeveloped land that could be used for a variety of purposes, including housing, farming, manufacturing, and energy production. But even relatively scarce land in ideal climates can be debased, as artificial islands can already be developed successfully. Off the coast of Dubai, Palm Jumeirah is an artificial island that has over 10,000 residents. Consequently, in the event that land becomes scarce, humans possess the capabilities to either create additional land on Earth or to explore the possibility of space travel. Additionally, square feet is not limited by surface land on Earth. The Burj Khalifa is the tallest building in the world, standing at 2,716 feet and 164 floors. Humans can build up too. This expansion upwards in construction technology was enabled by Henry Bessemer, often regarded as the father of the steel industry. His one-step process, introduced in 1855, revolutionized the production of cheap, high-quality steel. Moreover, the concept of owning real estate is often more of a legal construct, as real estate is an immovable object involving a ledger entry in a government database, and it's more easily subject to taxes and regulations. This means during times of war or excess government spending, real estate can be taxed more heavily. So even if you own real estate, wealth still leaks away year after year in the form of property taxes. Now, this doesn't imply that real estate lacks potential opportunities for generating future returns, whether that's through development, investing in undervalued areas, or leveraging other short to medium term market fluctuations. It simply highlights that concentrating a significant portion of wealth in real estate bets against human ingenuity and entrepreneurial ability to innovate and expand supply, devaluing the hundreds of trillions of dollars worth of wealth currently stored in real estate. Now, most importantly, the core of this argument is not just speculation that we'll eventually build more apartment complexes or discover more efficient ways to build homes, although both are very likely. It's that unlike savers of Bitcoin, holders of real estate must face the possibility that their supply will continue to increase in the future. As other real estate holders begin to recognize this reality and begin to understand that Bitcoin is the first superior alternative because it certainly cannot be debased and touts the necessary properties of good money, then the price of real estate relative to Bitcoin will continue to fall significantly even before any massive supply increase in real estate, just from a few holders cashing out for Bitcoin. Markets are forward-looking. If Bitcoin is going to be more resistant to debasement compared to gold, real estate, or other assets, even if it occurs very slowly, then you should still cash out to Bitcoin sooner rather than later. That's why Bitcoin has a compound annual growth rate of over 200% over the last 14 years. The world is rushing out of inferior assets and funneling capital into the apex form of property.